Drumroll, Cari, is now a good or terrible time to buy a home?
That's the question I get a lot, regardless of whether it's a pandemic or not. And I mean, it's a great question, but I also heard a really interesting saying recently where it's not about timing the market, but it's about time in the market, right? So think about that a little bit.
Hold up. We're live! Welcome, everyone. We're going to talk about, obviously, COVID-19's effect on the real estate and mortgage market. It's a weird time that we live in, all we can do is bounce back from that and show the opportunities in the market. So, Matan, welcome back. Welcome back, everyone. We're recording, and off we go. So, into our agenda.
Awesome. Well, we have quite a packed agenda for to talk to everyone about today, and we'll wrap this up as quickly as we can, just to, make sure that we cover all the topics. We're gonna just talk about intros, pre-approvals, real estate trends, and also conclude with a few interesting thoughts.
Yes, and one thing I'm going to try right now is a quick poll. I'm just curious to see where everyone's at. So I'm going to ask really quick. We're trying out this cool feature. Hold on. We're curious to know if people here are mainly renting, investors, or perhaps, I guess, looking to get a mortgage. So actually, you know what? I won't use the fancy poll option. Let's keep it simple. Can we see in the chat if you're either renting, looking to buy, looking to refinance, perhaps? Love to get a feel of the room. We've got a more intimate crowd here, so we can do that. And since it's only 8 of us, honestly, if you want to just, unmute yourself and say what you're looking to do, we'd love to hear that, or you can put it in the chat. Okay, so we got a home searcher. Cool. Yeah, we got someone who's renting. Cool. Renting but curious. Okay, cool. So lots of first-time home buyers. That's good to know because we do have some stuff we're going to cover there. We got a possible investor. I love it. Cool. Okay, that's great, guys. Well, that gives us a good feel. If you haven't typed in kind of your situation, we'd love to hear it. If not, that's all good. Well, I think we have a good pulse of the room. So thanks a lot. So let's get into a bit of the agenda. And, well, most importantly, some quick introductions. We didn't quite get to them. And one thing on the next slide, we're going to introduce Cari first, ladies first.
Yes.
And one thing I'll say about Cari is that, I mean, we both come from the tech world, right? And I've talked to her colleagues who worked with her in the past, and they're just like so impressed when they saw that she went into real estate because she is a natural relationship builder. One of the kindest human beings, one of the smartest human beings, who's also a stats major. So like that's a pretty deadly combination.
Oh, I studied stats. I didn't major in stats.
She studies. She's also very precise, right? So I'm really stoked that I'm getting to work with her on this and obviously get to educate you guys. So that's my little plug with Cari. I'll let her introduce herself as far as a bit of her background, how she got here.
Cool. Well, thanks, guys. My name is Cari, and I am a licensed realtor at Oakwyn Realty. And I specialize working in residential real estate with both buyers and sellers across the greater Vancouver region. And fun fact about my brokerage last year, in 2019, my office at Oakwyn Realty, we actually did the highest gross dollar volume of sales of $3.1 billion of transactions were done last year. So we were #1 ranked across the real estate board of Greater Vancouver, which is crazy. And I'm so lucky to work alongside some of the best colleagues. Coming into this, growing up, I saw how real estate has changed the lives of many around me. And it's a great asset for generating multi-generational wealth. And coming into this, I really wanted to help my clients achieve the same. So as well, just some background history on myself. Before coming into this industry a few years ago, I went into corporate sales at a reputable software technology company, a few of them actually, and I worked across Asia, in the US, and as well as Canada. And as well, another fun fact, I speak English and Chinese as well.
Very cool. What don't you do?
Uh, Please, Paul, you do way more than me. So this guy is very, very humble. He is an entrepreneur in the tech space, now running his own business in mortgages. And this photo that you see here, it's of him pitching his company back in the day on Dragon's Den, which is the Canadian version of Shark's Tank. So that's hard to beat.
Yeah, good times, right? That's back when I had less gray hairs. I guess that was in 2014. I think it's on Netflix. If you guys want to check it out, what is it? Season 9, episode 7. So, a lot of, I guess we have an inner circle now on the Zoom, and a lot of you will know a bit of my journey. But yeah, basically, started in the tech world, and then moved over into the marketing world, and I guess they're very much combined right now. But yeah, kind of come from the world of restaurant marketing and recently also real estate and mortgage broker marketing. And we learned from our customers pretty quickly, this is of course the mortgage brokers, that there's not a lot of people who market themselves well, and more importantly, people who actually educate first-time home buyers and even investors, really anyone, on all the different lenders beyond just banks. And also, I literally saw through my customers how they had to educate people to not lose $50,000. People who were leaving thousands of dollars on the table. People that were just rate shopping, but then they got stuck with a $20,000 penalty. So there's so much education that we don't learn about in school, and that sometimes you won't even learn about at the bank. When we're talking to someone who sells 20 other products, they don't know the details of very specific fine print. And also, there's so many other lenders that are really poorly marketed that actually can be quite amazing and accommodating you if you're self-employed, or if you have a very unique circumstance where you're just getting turned down at the bank. So that's been really interesting to kind of learn about the world. And then, yeah, Level Up Mortgages is kind of, as the name implies, it's about leveling up. It's about being the best version of yourself. And of course, we work a lot with entrepreneurs who depend on leveling up often, but anyone who's just self-improvement focused. I mean, really, I think everyone on this Zoom room that's looking to learn, I mean, we love serving you and just kind of helping you save money, not just short term, but like being strategic about how do you level up. And you'll find out that the way to qualify for a mortgage is your income, how well do you manage your debt, how well is your credit score kept, and how organized are you, which are all pretty key things to just live a great life. So I'm passionate about using my experience as an entrepreneur to pass on a lot of those tactics so you can qualify for really the best kind of mortgage and just for you to have the best kind of life with not a lot of stress. So a bit about the brokerage that I guess I've joined the network. I mean, we do 10 bill a year in mortgage volume. A really, bright team across the country. We get 48 plus lenders, which what really means is that we send them a lot of volume, especially some specific ones. A lot of them actually not being banks, and we get amazing rates, which is one of the very important components, of course, of getting financing. And as I said a second ago, if you got turned down by a bank and you don't have the traditional income that they need, there's alternative ways of getting financing that's actually a lot cheaper than you think. It's not like the loan sharks you hear about, although of course they exist. There's a lot of great options. So yeah, really pumped to be an educator and be a strategist with you guys. So we'll lead into my slide here around how to not lose money, because I'll take us a small story. So this was actually in the newspaper. I think it was a few years ago. And there was a lady, a mom, and her daughter went to York House at, of course, the high school there. And she was moving close to York House, and she had never gotten pre-approved. So she didn't know what the lenders would finance her for. And the seller told her that, hey, if your daughter is going to York House and we're in their jurisdiction, you're going to get total exemption. Like, you're helping out the local school. Like, you'll totally get approved. As you may are probably realizing and thinking about, what happened is she put a deposit down. I think it was about $50,000 on a more than $1 million home. And when she went to the lenders, I mean, she didn't have, she had gotten a lot of money from overseas, which didn't qualify. She didn't have stable income. She was, a stay-at-home mom. Of course, she had, a well-off husband who wasn't in the country. And basically, she didn't get financing, so she couldn't get, she couldn't actually buy out the seller. And the seller kept her $50,000, right? I think secondly, a big thing too, I think for people that maybe are a bit more practical and have a bit more common sense, right? About, house hunting. You're going to lose a lot of time if you're looking at properties that are just out of your price range. So I don't know, Cari, you must get people that, think they can afford more. And I mean, what do you do to kind of combat that? Do you make them get pre-approved before they view with you, or?
We have a process, and normally the first step is always to engage with a mortgage broker or mortgage specialist. So I always tell them, make sure you're approved for financing, and then we can start looking. Otherwise, I mean, I've done it before where you kind of do it in conjunction, and then it just leaves the buyer very
It's stressful.
it's stressful, and you don't get what you think you can get, right? So a little disappointed too.
Yeah, and the rules are getting tougher and tougher and tougher, especially during COVID. So yeah, just you want to see where you stand, but there's also some benefits too. As far as you don't want to lose money, but you can also gain money. So I'll talk about these 3 steps in the next slide here. And so yeah, I mean, firstly, what is getting pre-approved? Because I know a lot of us haven't got a home yet. So basically, it's you finding out from a lender how much money can you borrow and at what rate. Right? So the step to do that is you talk to a mortgage broker like myself, and all the lenders care about is how much income do you make, like recurring income in Canada? What are your monthly debts? So how leveraged are you? And thirdly, like what's your history as far as being organized and paying your debts on time? So i.e. your credit score. So once, we talk about this for like 15 minutes, okay, where are you at? And then you have to submit documents to back up what you're saying. So it's, your T4s, notice of assessments, letters of employment, pay stubs, all that fun stuff, which, things you should probably have on hand anyways. And the cool thing is that, to the header over here, you can actually save up to 10 grand from what I calculated is 28 minutes worth of time investment. So basically, you can do something called a rate hold. So if you look at like a very kind of conventional mortgage, let's say an average of $330,000, I think is the average in Canada. And we're seeing variable rates as low as 2.10% today. I mean, rates a couple years ago were up to 3.10, and actually some lenders are doing above 3 right now because rates have gone up again, right? So, but for variables, still really low. So if you save 2.10 now, you get 120 days to hold that rate. That's with most lenders. So let's say it's August 16th, and you found a property, a few days before, and you locked in your rate way back in April, and now the rates are 3.10. Well, what's the difference of that 1 percentage point across what would be let's say a 5-year term? That's about $10,000. So you can actually be $10,000 better off by spending 28 minutes to do your due diligence, really for your own good. But also there's a perk of you actually saving money and getting a rate hold. So there's more about that, of course, on my blog down there. But yeah, getting pre-approved is a no-brainer. It's not a lot of work, and it's just something you should really consider doing. So credit score, I get a lot of questions around this, and please, leave any questions in the chat box if you like. So basically, there's 4 ways to see what your credit score is. So do you pay on time? Do you utilize not all of your credit, but under 40%? So actually, lenders don't want to see you above 40%. It shows you're kind of pushing the boundaries. Age of credit history is really important as well. So, I've heard of stories where people actually cancel their credit cards when they're getting a loan because they think it's going to increase their credit score. It actually does the opposite, because your credit cards, your lines of credit they're actually proof that over time you've taken on credit and hopefully been responsible with it. Once you close that, if you do, that record is wiped. And suddenly lenders like, well, you don't have a good credit score history. So we have had like stories of people, they close down their credit cards, and then they go from like a 700 to below a 6 to even below a 600, which is where no prime lender is going to give you any money, because they kind of listen to the myth. So talk to your mortgage advisor, and I think that's an easy way to avoid it. And lastly, yes, there are things such as checking your credit score, it's called a hard pull, and that has to be done when you get officially pre-approved. What people don't realize is that it doesn't sync your credit score. There's other things that do. It's the things above there. I mean, your credit score is out of 900, so you might be at a 700 or an 800 or whatever it might be. It takes away 2, right? 2 points out of the 900. So if you're anywhere above 700, like, you're free and clear. So don't let that hold you back. I think that gets overhyped a lot. Although if you want a soft credit score pull, there's a website for that will do it. It won't affect your credit score, but it's just not as accurate. So you may want to do that right now if you're not super serious as of now. And there's a site called Borrowwell, which maybe Cari can link in the questions here. So that's a bit about credit score. I know I'm going pretty fast, but yeah, if you have any questions on that, obviously put in the chat. And again, I always have a blog post for it, so I can give you the full deets there. But yeah, credit score is really important, because if you have below 600, you don't qualify for prime lenders. You have to pay a higher rate.
Great. Thanks for that. Guys have any questions? No?
You've linked the website. Okay, awesome. So yeah, just a quick thing. Paul, what are prime lenders, A lenders, B, C lenders? So at the very bottom there, you'll see kind of that kind of how they're broken down. Those are general ranges on the rates that you'll see. So your prime lenders are, of course, your banks, your credit unions, and then you have non-bank lenders that I'll talk about later on. They're basically super legit institutions that have usually much lower rates than banks that nobody knows about. So yeah, but they're also very strict on credit score. So yeah, that's where you want to be ideally. If you're just outside of the way they qualify you, alternative lenders, or in other words, B lenders, they'll be a little bit more, and they usually do 1 or 2 year terms. So it's something that is meant to be more of a band-aid. And then once you can qualify and you have an exit plan out of the B lender, you go to A lenders. And same thing as private. They'll even do like open term. You can literally leave in 2 months from now because they know it's only a temporary solution, which actually can be very useful if you really want to get into the market. But again, you want to shoot for being with the A lenders and getting the best rate and qualifying in the best way possible. So anyways, that's how the lenders work in a nutshell. One of the myths is people sometimes get turned by the bank and they're like, well, the bank said I'm not ready. I guess I'm not ready. Try other options, as I mentioned. Pre-approvals, as awesome as they are never guarantees. The lenders really care about your property. That's the X factor. If you're on like a mobile home or outside of in a very remote area, or like, you know, it's like a very interesting like leasehold property, or it's something that's involved in more of the city. Like there's different ways that your house can be registered at the city. Those are important things to talk about and think about before you put down an offer. And then as far as minimum down payment, you don't, I mean, yeah, you can put down 5%, but you have to do it only if your house is under $500,000. If you're above $500,000, that your condo or your townhouse, there's a sliding scale you have to consult, and anything over $1 million is usually at least 20%. And now, especially during COVID, a lot of lenders are making you do a lot more than 20%, especially if you're on the alternative side. So yeah, just be careful and know your strategy, know your situation, and know what the minimum down payment for you is. That's really important.
Awesome. All right.
Cool. Now over to what's happening in the market, Cari. What's happening in Vancouver until now?
So great. Thanks everyone. And I know a couple of you are from Toronto here. So I wanted to just bring everyone up to speed as to what happened in the Vancouver market from January of last year up until now. So of course, right now we're in unprecedented times and everyone wants to know, you know, like what's the real estate market acting like? So it's always best to kind of understand what happened up until this point. So what you see on this graph, I did not create this. This is from the Greater Vancouver Real Estate Board. And it's looking at average sales price. And this is across all types of homes and all different types of segments. And essentially what we're seeing from January all the way to the end of the year, price hasn't gone completely, like it's not, I would like to say it's stayed relatively consistent throughout the year. The first half of the year, honestly, was a really, really weak real estate market in the Greater Vancouver region. And it had everything to do with last year, or the year previous in 2018, with the new BC speculation and vacancy tax. There was a new stress test on mortgages that was slapped on. There was also an increase of the 20% foreign buyers tax. It used to be 15, but they tacked on another 5%. And that not only was in Greater Vancouver, but expanded to other areas as well. So the first half of the year, we saw the effects of that. And there was a bit of a blip on price. But then as July rolled around, as buyer confidence came back, inventory was a lot lower at that point in time. And I also want to note the beginning of last year, there's lots of inventory, just not enough people buying. And then in the fall, that was kind of like our spring market. It just got delayed. And that continued on into the new year. And traditionally, like January and December, those are very slow times because it's the holidays and no one's really looking. But as you can see from January all the way until March, like it shot up quite a bit with low inventory and, you know, demand being there. And that was originally stemmed from the April 6th loosening of the mortgage stress test that was supposed to happen It did not, but if the stress test were to happen, there was going to be a huge flood of buyers coming on into the market. So the people who bought in the first 3 months, they just wanted to avoid the crowds, not have to go through so many multiple offers, although there was some, and just get it done with before it's more stress.
Quick question from Evan. Sorry, the last month, is that March?
Yes, the last month is March, correct. I'll get into April shortly. You guys have any questions about what you're seeing? So this is the average sales price, right? Not sales volume, but most people are asking, what happened to prices? Well, it's gone quite a bit up since last year.
Interesting. And sorry, is that condos, homes?
This is across all segments.
Cool.
Yeah, so this is detached homes, townhomes, apartments, condos, everything. All right. All right, so next slide. Okay, as you can see, I really like my bar charts and my graphs. So here, we're seeing that with the stats from the Canadian Real Estate Association, this data shows us that Greater Vancouver is still the fastest growing real estate market across all of Canada. Okay, so Vancouver at the top, and then Calgary, unfortunately, is going negative growth. And this is comparing March 2019 up until March 2020. And in Vancouver, the Greater Vancouver region, we saw a 46.8 jump in terms of sales volume. Now, Toronto's a very strong market too. And I just want to note that with this data here, Vancouver just had a really, really abnormally weak March 2019. Actually, the first half of the year was very weak. So of course, this jump might not reflect the normal numbers because it wasn't a normal market last year, but it's rebounded. So that's what it's saying in terms of rebound there. And going on into looking at some consumer behavior changes, okay? I wanted to split March up into two pieces. The World Health Organization declared pandemic on March 11th. So if we want to look at the first 10 business days of March, we saw an average of 138 home sales per day. It's great traction. There's a lot of activity happening. A few of my clients on this chat can attest to that. And there was an increase in new listings. And then after, post-pandemic, in the final 10 business days of March, we saw 93 homes sold and fewer listings being listed on the marketplace. So we're seeing a little bit of a decline, okay? And I also want to just mention that in terms of new listings, this is not all the listings that are available on the marketplace. These are just things that are popped up in the system as new homes for sale. Okay. Guys have any questions about this so far?
Evan had a quick question. I think maybe in the previous slide. What is the driver of the sales? Are people actually buying for investment, or is it driven by actual demand? Like what's driving it all? Do you know?
Yeah. Okay. So from last year up until now, there wasn't a lot of sales happening in the first half of the year of last year. I'm just going to say that, whether it's investment or whether it was for home buying. And most of it that I've seen and discussed with other realtors as well, these are actually for home buyers. Investors, like people ask, are there a lot of foreign investors, so to speak? We're seeing a lot less of that now. Now it's more, I see a lot of downsizers. You suddenly sell a house that's $3 million and then you can buy 2 or 3 condos. You can buy a couple for your kids, right? There's a lot of local people who are buying, and it has everything to do with, there was just pent up demand left over from last year.
Awesome, great question.
Yeah, thanks for that.
Answer.
And then in April, so we're still in April, the first 9 business days, I took a bit of a look at the stats. There are 63 home sales per day and fewer listings. And that has everything to do with, of course, the state of COVID-19 and some policy changes on our end. So as of late March, at the Greater Vancouver Real Estate Board does not allow us realtors to hold any more in-person open houses. Okay, so that has restricted a lot of people from coming out. People who have health at risk, they're no longer coming out, and they're just on a wait and see basis. We're seeing very, very few tenanted properties being listed for sale. And the reason for that is landlords can no longer issue a notice to end tenancy for any reason during this emergency lockdown. So that's very important to note, because that also restricts the number of new listings that can be popped up on market too. And another thing, just for health reasons, and I'll talk about this COVID-19 contract for waivers, if you were to do private showings, because right now, I have a listing right now too, and we're not getting a lot of like foot traffic or private showing, so to speak, because we're trying to qualify the buyer as much as we can before we let them come in. Things like that listing I had is a tenanted property, and I'll get calls from realtors and ask, hey, I have a buyer needs to move in by June 1st or mid-June because they sold their house. And I'm like, I'm sorry, like it's tenanted. I can't kick the tenant out for any reason. The only way I can do it is if you're flexible on your dates, right? So there's that happening too. Any questions, guys?
Good so far.
Cool. All right, so that's all the in-person consumer behavior. I'm going to touch a little bit more on what's going on online, okay?
All techies.
Yeah, all the techies. Okay, so this data that I took is essentially from rew.ca. This is no way representative of the entire real estate market, but for British Columbia, it is statistically significant because it is the #1 visited property search site in British Columbia with 3 million visitors per month, okay? So I wanna show you in terms of user viewership on their website, what it looked like in February 2020 and how it compared with March, okay? So this gray line that you see here, the squiggly, this is February. And then this blue line that you see here, that's March statistics. So this is measuring viewership across time in March. So with the declaration of the pandemic, which happened around here, we're seeing viewership on rew.ca drop quite considerably. And actually compared to February, dropped 40%, okay? But an interesting thing happened. Actually near the end of the month, viewership on the website, meaning people were looking at properties, actually went up quite a bit more. It's still down 17% from February, but it seems to have stabilized a little bit more in terms of real estate demand on the website. And I want to show you something else. So there's something called a bounce rate that REW uses to measure, you know, how much time people are actually spending on the website viewing properties. And they're like, normally on this website, they see bounce rates of 30%, which is the amount of time that one person comes onto the website and bounces off to somewhere else. Like they see a page and then they leave, right? So 30 to 35% of those people do that on a regular basis. But now, as we trickle on further into March, we're seeing the bounce rate become very, very low, actually only 7%. And actually talking to some of the folks at REW, that's the lowest that they've ever seen. So this really suggests that people are actually spending more time doing property searches online than ever before, right? They're not coming on to just look at one listing and then move on. They're actually viewing and spending their time looking at multiple listings and its data. So it also suggests to us that there is a market out there. It's just they're not in person. They're just sitting dormant and taking a wait and see approach.
Quick question. So like, is that because when they have a realtor that can just show them the different open houses, they just go see houses and they don't bother doing the research online? Is COVID a reason why they're like, crap, I have to do things more digitally? I now know how to use Zoom more. Like, is it because people are more tech savvy? planning for a rebound soon. They're forced to do it. Like, why do they do that? I understand the behavior, but why do you think that is?
Well, people are online for a multitude of different reasons. And now, because they can't do their research in person, it's all about doing it online. And actually, I explained that a little bit more in my next slide. But normally, I would love to have as many people come through my listings. Yes, to private showings. Yes, to open houses. But we actually have to do our part to protect our sellers, our buyers, and the public. So we actually have to limit the amount of people that come through. It's not that we don't like people anymore. It's just we have to adhere to Health Canada guidelines too.
Mm-hmm. Great. Awesome
Okay.
answer.
All right. Okay, so this is, well, since mid-March, the home buying experience has changed a lot. It's, for me, it was like drinking out of a fire hose. There was so much to know. And I'm very pleased to share with you what's going on. So there's a few things that's changed quite a bit, okay? So connecting with your realtor has been so digital these days. I'm using things like Zoom, like FaceTime to connect with my clients. Before, we would connect at a coffee shop or come to my office and, you know, get to know each other better. Now it's just done from the safety of our couches at home, okay? So as techies, I know techies love using technology. This is a great thing, right? You know, you could cut down on your commute time, but I do love and crave that in-person connection. So I'm so excited for when this whole pandemic is over and everyone's healthy to meet one another again. But technology has been a huge thing. The second thing is viewing property. So going back to what Paul said previously, people are taking tours of open houses at home nowadays, right? People are doing some really cool things like virtual open houses. I can't go take a look at properties in person, but if it is a vacant or owner occupied property, myself as a listing realtor, I can take my phone, I can turn on IG Live or Facebook Live, and I can just show people like the property like this. And people can ask questions and ask, hey, what's the square footage? What's the maintenance fee like? What is the view, right? What's going on across the street? So things like that. And that's pretty cool. And it's very interactive and it's posted online for you to share. Another thing that's really cool and I'm seeing a lot more of is 3D virtual tours. Don't know how familiar you guys are with this technology. It's not new, it's been around forever. 3D Matterports have been done in the past, but I wanna show you very quickly something that I did for a recent listing of mine. And this is what we call a virtual tour. Here, I'm gonna expand this, okay? So it's essentially a photographer comes in and he takes he shoots 3D images of your listing and you can click around and it almost feels like you're there in person, right? So this is a 2-bedroom, 2-bath that's located in South Vancouver, the area where I grew up. And you know, it's a newish condo. It's only 5 years old.
Carrie, are you showing it right now? Because it's not showing on the screen.
Oh, it's not?
Yeah.
Oh, okay.
At least for me.
That might mean for everyone else too. Okay, are you guys seeing it now?
Yeah, now it's changing. Yep.
Okay, awesome. Sorry, guys.
No worries.
Okay, so this is what it is. This is a 3D Matterport. Oh, it's lagging. Okay, maybe it's just the stream, but it feels like you're inside the listing and you're walking around yourself. So you can see what the view is like. This is the patio. The tenants can play beer pong here. You go on the other side of the patio, have a tan. You can look at what the view is like. This is of Southwest Vancouver.
Wow.
Yeah, so close to SkyTrain. So this is the type of thing that we're seeing very regularly now. It used to be for luxury properties will get this type of technology, but because of the COVID-19, everything from low end to high end properties, like we're seeing a lot of this now. And it's great because it gives you extra like research and you can take a look at this for as long as you want at home.
Quick question. Rosalind says, what's the feedback once a client sees the property live after seeing it on 3D? Does it look the same? Are there things they maybe pick out when they're there they don't see on 3D? Like, what's the variance in like perception, I guess.
Oh, totally. Yeah. So there are things like you can't really see from doing this 3D tour. If they really like it, you know, they might want to see the depth of these built-in wardrobes, right? Like you don't get to see that, right? They might want to just get a feel of the place themselves. Like you don't get to see the texture necessarily of the carpet or the tiling.
Right.
So if they like the layout and they're happy with the square footage, and they just want to get a better sense of the property, they're more than welcome to come through.
Agreed. And I was going to ask, and I think Eben has the same question, when can we see this in VR or AR, right? I guess we're maybe too early in the curve, but I think it would be really neat.
You technically could. And I didn't have that functionality set up for this one, but there are technologies that allow you to do that.
Yeah, it's coming.
Okay. And another thing, sorry, it's 7 o'clock and people are pounding on their
oh yeah, of course. Well, we should be, yeah, for our frontline workers.
Yay, loving it. And other things that you have to view before you take a look at the property is videos and floor plans. And listing realtors are really good about sharing that information with the public, but normally you would get that through your realtor. So these days, is more than ever, you need to leverage your realtor. And a couple of my clients can attest to that, because when you're going to view a property or you need to find more data about that property, a lot of the paperwork or the floor plans, videos, etc., you might need to get it directly from your realtor that you're working with, right? And there's a COVID-19 waiver that you need to sign to say that you've never visited abroad in the last 14 days, you're healthy, you haven't been exposed. There's a whole slew of paperwork that you need to do nowadays just to get a private showing. So we always want to make sure that you do all your due diligence and you're absolutely sure you really like that property before we go see it, okay? And then the other thing is really too, there are a lot of more off-market deals, right? Not everything on MLS that you see is the entire market. There's stuff that's, you know, expired or listings that are going to be posted up but have not yet, and other realtors have this inventory. It's up to your realtor to network with these other real estate professionals to ensure you get the inventory you want. Because the great thing about these shadow inventory or exclusive inventory is if you can get in early, you have no competition. So just to give you an example, my sister-in-law, she just sold her 1-bedroom condo in Yaletown. They previously had listed it in fall of 2019 for 720 something thousand. Great area, but got a few accepted offers, but just kept collapsing due to whatever reason, financing or what have you. So they got frustrated, took it off the market and said, you know what, we're just gonna rent it out and we're gonna see what happens in the new year. So then before they even had a chance to relist it back up, there was a woman that contacted them and said, hey, I just sold my townhouse. I need a place to live. It's COVID-19. I've seen your unit last fall and I absolutely love it. Are you still selling it? And then they just made a private deal offer. So the seller's happy. My sister-in-law's happy because she doesn't have to pay like the seller realtor fees. And then the buyer's happy because she doesn't have to set foot in anywhere else because she knows this place and there was no competition, which is great. So there's things like that. And then other things like pre-sale assignments that are not listed on MLS. This is stuff like new developments that are hitting the marketplace, but you go to a sales presentation center, you buy a unit based on the floor plan and you have that contract. But people's situations change, right? Some people can't wait 2 to 3 years down the road. So what they do is maybe they need the financing, maybe they need the money that was supposed to be put towards that home to something else. So then what they'll need to do is they'll need to sell that contract. So oftentimes these are not on MLS, it's off market, and working with a realtor that has these connections with the industry, whether it's builders, real estate professionals, developers, that's a very good resource for you, especially at this time. Okay.
Super cool.
Awesome. So that's it for me for now. I'm going to hand it over back to Paul.
Hard to follow up that act. Damn, pressure's on. Very cool. Well, look, I mean, I guess even on the, and thanks for that, on the financing side, there's also been some innovations with yeah, how people were approaching their mortgages. I really think for the better. So the stress test, and maybe I'll go over really briefly the stress tests for those who, haven't quite wrapped their head around it. It's basically a way to qualify you, right? The government qualifies you, and they'll usually add 2 percentage points on top of the rate that you'll actually get. So let's say you're getting a rate of 3%, they'll add 2 percentage points, or they'll take 5.19, which is now lowered to 5.04. So take the higher of the two, and they'll say if the rates were to skyrocket 2 percentage points, could you still make your mortgage in a way that we deem acceptable? Which a lot of people it's very controversial because people are like, the rates are never going to go up by that much. It's way too big of a buffer. Here's Canada again, getting all conservative. But I think the government is realizing that, and that's why they've looked at a different way to do it. Anyways, the actual stress test change was going to be on April 6th. That got pushed back for now because of COVID. They've loosened the stress test benchmark just by a little bit right now, but still, it's in our favor at the very least. You'll find that, there's actually a lot of credit unions who've just shut off for mortgages, and you can't get a mortgage through them. Why that's a bit of a pain is because a lot of credit unions are very generous on your rental income. Because let's say you are, you're buying a property or an investment property, and you also want to use the rental income you will make from that to qualify you for more. Makes sense. It's going to be pretty steady income, of course. Some lenders don't see it that way, and they'll calculate maybe half of that rental income instead of all of it. And they have different ways to calculate it. So the credit unions not being around as much as they were before is a little bit tougher, but there are a couple that are still pretty generous with rental income. So obviously, if you think you're on the cusp of financing, let's have a talk around what we can do and strategize around using rental income to help you afford more. Variable is a lot lower now, and without getting too much into the economics, it's just a lot lower than fixed because the overnight lending rate, right? The prime rate's going down. The bond yields have gone down, and bond yields mirror fixed rates. So when you ever see Google bond yield, and if that's going down, the fixed rate will usually follow that. In fact, the first 3 months of March, there was literally rates at 1.99. Right. But I think as that went on, the banks were just like, and the lenders were like, we don't have a lot of liquidity now. Even if the bond yield is down, we need to charge more of the consumer. We can't really pass the savings on to them. So yeah, for now, variable super low. I know, Cari, I know you're on a variable, and you've got an amazing rate right now. Maybe a year ago it wasn't sort of the same, but there's a lot of, I guess, variance in variable rates. That's why about 3/4 of people get fixed. But for now, variable is very tempting. And if things stay as low as they are, it could be good for a while, especially if you do a 3-year variable. And the last thing is a lot of people have to consolidate cash flow. So if you already have a property, for example, or you want to get a property, but you can't really afford, even if you get qualified, you can't afford a full mortgage payment every month. Yes, there's deferral programs, but also what you can do is you can extend the period that you pay off your mortgage, otherwise known as the amortization period, from 25 to 30 years. So you're paying more long-term with interest, something you have to keep in mind. But short-term, since it's stretched out for longer, you're paying less per month, so you free up cash flow. And I actually just saw a program today that you get 3% cash back based off your mortgage rate. So if you have a $500,000 mortgage, I think you get $12K, which even though it would be at a higher rate, you get a lot of cash up front. And when you do the math between a lower rate today, no cash back, and the cash back at a higher rate, you're still about $5,000 better off, which is really interesting. So there's been some creative promotions from lenders that I think we're all directly benefiting from. So those are kind of the 4 main effects. And I've already kind of primed you and kind of gone in depth. But yeah, just to recap, again, the stress test has been down to about 5.4, which basically means, as I explained, is that you can qualify for a little bit more. And if you just click enter again, Cari, it'll show the grand total of how much more you can afford. So if you can afford, let's say your max was $500,000, it's now 506. So the buying power really hasn't increased that much. It's a temporary measure, but we hope that that's going to be a lot different when the actual reposition stress test will hopefully come into effect. I mean, as soon as this is all over, maybe in the summer or the fall, and obviously I'll keep you apprised as that happens. And so yeah, this is just an email that I got. Literally, I was looking to qualify a client who needed rental income to afford the property that they wanted, and I got this email. We've temporarily shut down due to the virus pandemic. So sorry, can't help you, which I thought was just whoa, things are getting really serious, especially for some of the smaller lenders. And keep in mind that you also can't visit branches right now, so you have to be remote. So are your bankers doing Zoom calls with you? I don't know, maybe not. That's why if you have a progressive mortgage broker, you can just do a Zoom call or a phone call, right? So I think now is a really prime time to get advice remotely. But yeah, that was kind of crazy when I saw that. So there are some lenders that are not open for business right now for mortgages, or they're making you put in a really large down payment, which makes it quite prohibitive. And yeah, quick thing on variable versus fixed. The variance is about 0.34, just kind of averaging it out. So again, variable is lower right now. The fixed of 254 isn't bad. You know, like again, we're seeing as low as, you know, very low twos before, but now it's kind of average, but still on the lower side, which I think is still probably worth getting a pre-approval and locking in that rate. We've got a few more kind of points here. Yeah, as I said before, like 3/4 of people choose fixed rates, but actually, if you look at the stats of lifetime fixed versus variable, variable is lower. You actually get a better deal off variable. Again, for fixed, you lock in a rate, right? So it stays the same every month. You have the peace of mind. With variable, as the prime rate changes over time, then you may have to actually pay a bit less one month versus a lot more another month. But overall, it does average out to be less than fixed. So it just depends what your risk tolerance is. So that's kind of the first thing I consider. And there's 2 more points here. So just things to think about when it's fixed versus variable. What's your tolerance for monthly interest rate fluctuations? And yeah, how low is the fixed rate today versus the past? And again, 254 it's still on the lower end, so it's a good time to get that locked in. And yeah, one huge thing is that 2/3 of people break their mortgage. And remember, you can break your mortgage by, you know, God forbid you get divorced. If you sell your house, it's called breaking the mortgage. If you refinance your house, so if you take out equity to free up cash flow for an emergency fund or to pay for something urgent, or even just to invest in another investment property, that's called breaking the mortgage. And it can really cost you a lot. And banks especially have rates. Their breakage penalties are a lot more. And I think I'll go over that in a subsequent slide.
Oh,
so quick question I see.
Rosalind had a question that even at 2.54 fixed, you think less interest would be paid with a variable rate?
Yeah, well, look, you'll definitely have a lower payment. And yeah, usually the way it works is that, you know, the lender will do prime minus X or prime plus whatever, if prime is really low. So yeah, as of now, like the effective interest rate, if you do that calculation, is that variable is a lot less expensive as of now. Yeah. But again, that could change.
Yeah. Because like right now, my mortgage is 5-year variable, but it was prime minus 0.75. So my interest rate right now is only 1.7.
Which is crazy. And but at its highest point, it was how much?
3.2.
Right. So there's a bit of variance there. But yeah, great question. Thanks, Rosalind. So yeah, quick thing on big banks versus non-bank lenders. So if you guys have heard of like RMG, MCAP, Radius, Marathon Mortgage, like you probably haven't heard of them, right? Like the First National is a bit more well-known. They're these non-bank lenders. They're kind of like wholesale lenders where basically they actually get funded by the big banks and investors, okay? And because no one knows about them, they have to have lower rates. But what's cool about them is that they're kind of like a startup, like a well-established, thanks so much. I see someone's checking off here. What's really cool is that they're very nimble and they're very specialized. All they do is mortgages. They've got much lower rates and their investors are the banks in the market. And when you're an investor, you want your money to go to work. So they have a mandate. They have to spend their money. They have to loan out money. So that's why they have lower rates as well. They have to use the capital, right? Because there's investor pressure. So basically, there's an article that's wrote in the Huffington Post that big banks really are comfortable, but like the worst deal around. And there's an example where they talk in the article how like an RBC from last year versus the lowest non-bank lender, which again, this is still prime lending. There's a difference of like 0.5%, and over your whole, 25-year mortgage, like you're saving $40,000, right? By going for someone who's a little bit more unproven, but that is funded by a big bank and just does mortgages. So obviously, as brokers, this is kind of the best kept secret that we love to talk about because it's crazy how much people are overpaying just for comfort. I mean, it's as simple as that. Yeah, just to compare banks versus non-banks, we do work with banks, by the way. Scotia and TD are the banks we send the most deals to. They're the most they're most broker friendly. We work with them a lot. So with a big bank, like yes, beyond the safety and peace of mind that you do your banking with them, someone there, it's more convenient, which I think is like it's nice, but I don't know if it's $40,000 worth, to be honest, right? But they can be more flexible on your ratio. So again, your debt to income ratio is how you qualify for X amount of mortgage. And because they're investing out of their balance sheet, it's their own money, they have more discretion. But when they invest in a non-bank lender and they're like, hey, like this is our money, take good care of it. If someone's ratios are off, or if their debt and income aren't exactly where we want it to be, we're not going to be as flexible. So if you need more flexibility, if you're just at the cusp and you can't qualify off more rental income, which again, the non-bank lenders and the credit unions are better for, then a bank makes a lot of sense. And the second point is that with a bank, if you want a home equity line of credit, so again, you can pull out equity based off of the value of your home. Banks are quite flexible with that, and they can make a revolving credit line where you have a line of credit. It's tied to your bank account, and you can just take money as you go, and you won't get charged for it. That's another reason why I think what's called a HELOC, home equity line of credit, with the big banks is quite good, and the rate on that is usually a little bit lower. So that's the second bullet point. And I'll go over to talk a bit about, of course, the non-bank lenders. So yeah, non-bank lenders, again, like far lower rates. Even today, I checked the rates, and actually the variance is quite small. It's usually a lot bigger. It's up to 0.5. But yeah, I got a 249 for rate. For this is, of course, guys, this is all fixed rates, by the way. We're going to stick to fixed here. Variables, they're quite comparable. So Radius Financial, which, I mean, who's heard of them? Like, I hadn't heard of them until a couple weeks ago, right? So they have a 249, and TD's at 2.74. So if you hit the bullet point again, I'm not sure if I put the math in here, but yeah, basically you'll save 20K over 25 years if you have a 2.49. Again, this is a small delta. It's a small difference. Usually the delta is double this, and that's where you're looking at saving 40K over life of a mortgage. So again, that's a lot of money, right? One thing as well is that breakage penalties are much bigger for banks. Okay, so if you when we talked about ways you can possibly break your mortgage. So the breakage penalty basically is I would see no more than $5,000 for a non-bank lender, and there's a specific calculation on whether it's 3 months worth of interest or IRD. If you're really curious, we can talk about it offline. But basically, think about it as between 0.8 to 1.5% of your total mortgage is what you'll usually pay on brokerage fees. On breakage fees for your penalty with a non-bank lender like Radius. With TD, it's usually anywhere from 3, so I've seen up to 15% of your mortgage, which is crazy, right? Some people have literally $40,000 breakage penalties, right? So actually, if you see a 2.95 on the market, let's say with a TD or a Scotia or any bank really, if you look at the thought that you might actually break your mortgage, there's 2/3 of people who break it because of life happening. That 295, if you include the actual breakage penalty of let's say 15K, that's like as if you were paying a 4.5. If you actually do the math, it's like you're paying a lot more. So again, cheap rates are great, but think about the things, the variables of what could happen, right? So just things to be aware of. And I mean, you're not going to see that in the fine print usually with, well, you will, but there's a lot of paperwork, right? So those are just kind of the facts on, just things to be aware of. And I talked about rental income, of course, as well. Last one around self-employed. You're self-employed. Usually banks will look at your gross income, but after you write off expenses, because as you're self-employed, as you may know, if you have certain expenses like a home office or computer or travel, you write it off so you pay less taxes. That's something a lot of people do. But the lenders are smart, and so are the banks. Like, well, we're going to go off what you've written off, and then after write-offs, a lot of people just can't afford what they want. So there are some options with alternative lenders or B lenders, and if we just click a few times to get the bullet points up, you'll see that, most lenders, again, take what's on your notice of assessment. Some non-bank lenders will take what's in your bank account. So if you pay yourself $100,000, let's say, right, or even 50 or 80K, and you're declaring, let's say, half of that, they'll be like, well, let's be practical here. You're actually getting paid that much. I know that if I know your risk level for defaulting is based off what's actually in your bank. So we're going to be flexible, but there's a slightly bigger risk if we do that as a lender. So they'll have a higher rate. It won't be by many more. It might be like a 3.5, 3.7, but still, like, that's not bad, especially if you're self-employed, right? And yeah, I talked a bit about the cashback mortgage I heard about today. So one lender doing a cashback where it's 3% of the total mortgage amount can be paid up front. So if you have any upfront expenses, or if you want to just, save cash or maybe invest it if you're really risky, then, you may want to consider doing that. And that's off the bat. And as I said before, like, even though you pay a slightly higher rate, if you do the math, you pay a low rate today with this lender and there's no cashback, versus a slightly higher rate with the cashback, you're still about $4,000 better off having a slightly higher rate and then getting the cashback. So when you're actually shopping for a mortgage, inquire about not just what the rate is, what the penalties are, and if there's a cashback potential as well, right? All those things. At the end of the day, you want to save money. The rate is just one of the factors.
Okay. But whether it's a good time or not to buy a home, it's really up to you, and you need to ask a few questions to yourself. Financing, right? How is that going to work for you? How is your cash flow? And have you budgeted for something like this, right? Because there's something like a down payment, mortgage pre-approval, and cash. How much house can you afford? Okay. At this point in time, are you comfortable viewing properties virtually, right? Are you okay with doing that due diligence virtually before stepping foot into a home, right? Because our economic and, I guess, health climate has changed quite a bit. And in-person private showing, if that's required, are you in good health to do so, right? Doesn't always have to happen. I had a colleague who sold a 2-bedroom out at SFU, $600-something thousand property. It's a local buyer, but didn't need to view the property in person. They were immunocompromised, and they said, hey, you know what? I like that private showing that you gave me on the phone. That's good enough. We're gonna put an offer on it. Okay, so the first time they saw it was that inspection. So there are people who are willing to do stuff like that. And things like your timeline, right? Like, what does your timeline look like? Is it flexible? If it is, you might have more options because owner-occupied, tenanted properties, sometimes they'll need a little bit more time to, move, or maybe they have a specific date in mind that they need to sell by. So if you are flexible, that gives you a lot more opportunity at this point in time. Cool. So economically speaking, right now, borrowing money is still very cheap. It's cheaper than last year and the years previous, I suppose, Paul. But if there's fewer people in the marketplace, if you see something you like and you are working with a realtor and getting your financing put together, and there is something there, why not? Just put an offer. Do as much due diligence as you can online and see what happens, right? Oftentimes you can get a good deal. Prices right now, though it is really, really high as of March, actually started seeing a little bit of a drop a few days ago in terms of pricing. And these are some owners who have bought another property and they need financing from the existing one that they need to sell to pay that other property. Yeah. So there's things like that happening too, right?
Yeah.
Okay, so if that wasn't enough for you to believe me, I want you to know that when people think a recession, they always think back to 2007 and 2008, okay? The recession does not equal a housing crisis, and I'll tell you why. And because right now what we're dealing with is a pandemic, it's a health-related situation. What you saw in 2007 and 2008, that was everything to do with the housing market. It was mortgage-backed securities that was really causing, the economic crash. People were using their homes then as ATM machines, and they're drawing so much cash out of their homes. And when prices drop a little bit, they're in negative equity. And what's the best way to walk away from negative equity is to turn the key and walk away from your home, right? But right now it's not happening like that. And economists are showing us why it isn't so. Oh, sorry. So the pros at Goldman Sachs, JP Morgan, Morgan Stanley, are the people who did a bit of research on previous pandemics, things like SARS, things like H2N2 and the Spanish flu, what happened to the economy in terms of recovery. And you'll see that it's a V shape. type of recovery. It's going to, drop down quite a bit very quickly, but the rebound's going to be very fast, right? So you don't have to believe me, but at least believe the experts who actually have done the research. Okay. So the V-shape, this is just from Harvard Business Review. It's talking about SARS, Spanish flu, and other types of pandemics have happened in the past, and they all followed the same trend, right? So yes, we're going to see a huge dip in terms of sales, in terms of impact, but we're going to see a rebound. And once it rebounds, it's going to happen very quickly when it does.
Mm-hmm.
Okay.
So what now, Cari? What now?
So when you're ready, and if you're ready, even if you have questions, right? I welcome you to set up a time to ask me, Cari, I'm a realtor in Vancouver, and Paul, your financing expert, to discuss, what are your options and are you ready? It never hurts to chat. And I never want people to feel like they're wasting time. It's not, right? More information is better than none. And we're tech savvy people. We'll do things like we'll jump on a Zoom call with you, we'll do Google Hangouts, FaceTime. We even do things on House Party app, we'll connect with you, right? And we want to make sure that when you come out of this, or if you plan to, hunt during this time too, that you're absolutely ready and you're armed with all the knowledge about, what you can do. And when you come out and actually put down an offer, you come in strong, right? So we want to craft a strategy around that for you. Anything to add, Paul?
Well, I mean, look, we're all stuck inside now and probably have more time on our hands than before. So now the time to be proactive. And as you guys saw from the presentation, right, like it costs, it's very expensive to not be proactive. And it's also very lucrative to be proactive. And it's not any crazy rocket science. I mean, just a lot of stuff you can read online yourself, and just, if that's your style, great, do it. Obviously, as you get more specific to your situation, yeah, talk to an expert and, use the best of both worlds. But there's so much great information. Just get informed, because so many people just get caught like in the worst of moments where like they really get scarred and then they're discouraged, right? Which you don't have to be if you're just a bit proactive and you're smart about things.
Awesome. Well, thank you so much, guys, for sticking around. Like the beginning didn't start off as planned, and thanks for jumping back on to this private room. And we really appreciate that. And of course, we're easily found. This is our contact information. We're also social too. So add us, follow us on Instagram, Facebook, and YouTube. And this is the time where we ask for questions.
Yes, thanks so much. So we had one question here, and it's probably for Cari. Cari, what is your take on prices going down for condos versus detached homes and townhouses?
I want to say the person's name, but it's like a dot. Hi.
They're purposely anonymous. Dot has a question.
So it really depends, right? Greater Vancouver, like there's so many cities. There's City of Vancouver, North Bend, etc. And I'm seeing different according to the area. Like I pulled up some stats this morning and I looked at like studios and one bedroom condos, so to speak, comparing from February and March. And I saw a slight price decline, right? So not huge difference. It's like $1,000 just across the board on average. We saw the price like blip a little bit. So that could be good news for first-time home buyers. Whereas right. When I was pulling up the stats, and of course, this is not, the stats I'm pulling up is across the region. 2 bedrooms, 3 bedrooms, single family homes. I'm seeing also overall as a trend, it's trending upwards, not by a lot, just by a few percentage points, okay? But that's not to say there aren't deals to be found, right? That's the general consensus. There's certain regions where, like say for example, Coquitlam area, for those who are from Toronto, it's like very similar to a Vaughan. In that particular area, like I'm seeing for 3-bedroom townhouses, the prices are going up slightly, but for condos, for some reason, the price trended slightly downwards. Okay? So it really depends. And of course, it's hard to tell because inventory is quite low, and all time will tell. And we'll continue updating you guys too.
But basically, I think we're at an interesting point now where things are happening, right? So I think it's a great time for you guys to just be informed and just be proactive, right? Great, awesome question. So friends, if you want to unmute yourself and ask questions now, we'd love to, if you want to turn on your camera. There's only a few of us left here. So if there's any more questions, please ask away. We had a lot of questions on the chat, and we really appreciate all the interactivity, everyone. So yeah, we'll have this recording up. If you have friends who missed this, who wanted to make it, and of course you have our contact information. We'll send out a follow-up email with the recording. And yeah, we're happy to see you guys level up and get to where you want to be. So thank you for being curious. It will pay off. And with that, I guess we'll kind of stop the recording and stay healthy, everyone.
Bye. Thanks for joining us. Stay safe.